Welcome to the Rose Show podcast. Thank you, everyone, for joining us. I am here today with Robert Falco, founder and CEO of Falconium Trading, market.
That's why I got the green light back there today.
Maybe that's good luck. So let's begin. You're a trader, you're an investor, you have a vast background in the financial markets. So tell us a little bit about your background and how it all began, Robert.
Yeah, so my background, I actually come from a banking background, a bank that rhymes with Fells Wargo that people probably are rather familiar with. I worked there for 15 years. I started in 2001, and I started as a teller and had worked my way all the way up to a senior vice president. Did many jobs throughout the banking industry. I was managing branches during the global financial crisis. So that was really interesting. I had a lot of great key learnings there. I met a lot of awesome people. I got a chance to move to different areas of the country. Had a lot of fantastic experience. I separated with them, which is a whole, like we could make a whole another podcast on all of that stuff that went on with Wells back in like 2016 or so. Certain things probably can't talk about, but if you've seen the Netflix documentary, then you probably know of some of those things that are out there. And at that time, when I left, I did walk away with a package to where I was getting paid my salary for quite a long period of time still. And I told myself I had always been interested in markets. I had traded a little bit, but had done a lot of long-term investing. And so when that happened, I told myself I was never going to allow someone else, like in a corporate office somewhere, HR or any type of thing, to control my destiny after that. It was very stressful when I left the bank at that time, from attorney stuff to OCC, SEC, all types of issues. And I did not want to go to another bank and like have a possibility of that happening again. So I had already started actively trading a little bit. I reached out to another trading education company, and I talked to their CEO, and I'm like, hey, here's my goals. I don't want to have anyone else control my destiny. And I was in a good spot where I didn't have to make money for well over the first year because I was still getting paid. So that gave me a lot of learning opportunity. I spent a lot of screen time doing that. I ended up working for that company for trading education for a while. And then we had some disagreements about directions of strategies and certain things like that. And so I decided to do my own thing. And I started Falconium Trading. How that kind of came out was, obviously, my last name is Falco. And when I started trading as a business, I was coming up with names for my LLC that I was trading in. And I was talking to a friend, and he suggested that play on my last name. It was either that or Hindsight Capital, which I actually kind of liked. I kind of wish I would have done Hindsight Capital for my trading business, but that's okay. I like Falconium too. And so it's, again, a play on my last name. And I've been doing that for a little over a year now. All the while, I've still been investing in other areas outside of just the market. I've always been interested in real estate. I actually just sold my last rental property in California. I do have some other, limited partner type investments, but I do think that the real estate market is probably going to pull back a little bit more. And so a 1031 at this time, like I just really did not want to do that. And unfortunately, when you sell real estate in California, even if you 1031 it, like it still follows you to other states. So if I ever realized that gain, California was going to come claw back that money anyways. So I figured, hey, you know what? I might as well just get rid of this thing. But I got to experience some really great opportunities. Like when I was in Arizona, from a real estate investing standpoint, I bought a house for $90,000. That was a bank owned property. That was 4-bedroom, 2-bath, 2,200 square feet. We had bought a house in Vegas at the time, super cheap, that had been redone, I think by BlackRock. They had bought up a bunch and then redid some of them. So I don't want to say lucky, because my first condo that I bought like at the height of the market, and I had to bag hold that thing for a while. But with real estate, generally, if you wait long enough, you're usually going to be okay. So yeah, had some good real estate experience also, but I love investing. I love the stock market. I love helping people understand that investing is really not that difficult. There's ways that you can earn great returns by just following indices, etc. And I do think that there are ways that you can outperform the indices if you want to put in a little bit of work. I don't think that trading specifically is a get rich quick scheme or anything like that. And I know that a lot of traders that want to just trade full time, quote unquote, are severely undercapitalized, and they don't realize like how difficult it'll be to make a full-time job of it unless they have a really substantial amount of money. You know, they're not going to be able to do it with $25,000 or $50,000 usually. So yeah, that's kind of a synopsis there of where I've been and what I've done. And yeah, you can pick on some of those topics to expand more if you'd like.
Thank you so much. I love that you gave us a lot to work with. We're definitely going to go into the real estate and bank-owned properties. That's a fascinating topic. Also, I love you speak about diverse, different asset classes outside of the 60-40, the stock market, and looking at other asset classes, especially real estate, which is key, great for, I call it semi-passive income, because it's not truly passive and there's always something going on. I mean, triple net is great, allows for more passivity. But yeah, I think that we should definitely talk about real estate. And then you're a true entrepreneur. I have to give you credit, and I admire that. Even though you had a little cushion, like you said, you disclosed that you had about a year compensation to you, so it gave you that, that little, safety net to pursue your dreams and your passions. And you didn't want to have a boss, and you wanted to live life on your terms. But it still takes that pioneering spirit to just say, I'm not going back in that direction. I'm going to go for it, and I'm going to follow my passion and what I want. So I admire that. So founder, CEO, entrepreneur, trader, real estate investor, Robert, that's so awesome. And I love your name, Falconium Trading. When I first came across you, I thought it was a really cool name. And like, I think of the Falcons, and I think of the bird, I think of all that. And then I realized your last name is Falco. So they're very creative. So 2 thumbs up on that one, in my opinion. You talked about, beating the benchmarks, and that's key, generating alpha. So, and that's what we're seeking. We're seeking alpha. We want to have a durable alpha in all markets. So we're definitely going to get into your trading styles, your investing. And, it's funny you said California finds a way, they come after you. I feel the same way in our state of New York. There's somehow, they always find a way to get a little something, a little crumbs of whatever you're making. So I get that completely. And then you touched upon one word, luck. And, that's a very popular topic. People toss around saying, is it hard work? Is it mindset? Is it effort? Is it talent? Or is it luck? And I think it's a combination of all of the above. And I do believe in, you work hard and the growth mindset, and that, anything is possible if you put your mind to it and you embrace challenges and you turn them into opportunities. And I do also think there's a little cherry on top for that luck. Jim Simons, he's the founder of Renaissance Technology. I've had the high honor of encountering him at a gathering once, because I live here near Renaissance Technology, and I have quite a few friends who work there in East Setauket, New York. And he actually said in a great interview, it's on YouTube, that luck is actually an important factor. I think he said there's like 5 key drivers for success, and that luck was one of them. So I do believe in luck. So it's great that you mentioned that term. So, okay. So I think we'll dive right in. Before we leave the banking topic, I'd just like to know from your insider view of what you can talk about. How was it being the senior VP of a large money center bank? How was it from the inside? And now, in hindsight, which could have possibly been the name of your trading company, in hindsight, how do you view where you were at, and how do you see it differently on the outside now?
Yeah. Well, wow, that's a big question. And again, I have to be a little bit careful with how I explain some things. But it was fantastic from a standpoint of experience. I mean, I learned, I didn't go to college. So actually, well, I went for like one class. It was English 1A. I did it when I was in high school, and I'm like, this is not for me. I'm not going to do this. So, all of my learning came on the job in the banking industry. And so it was one of those things, like I was doing loans, like the ninja type, HELOC loans and stuff back in like 2005, 6.
Mm-hmm.
I was a banker, like processing those things. I was a branch manager during the financial collapse. Like there was a Washington Mutual if you guys remember that bank. That was,
WAMU, of course.
yeah, it was across the street from the branch that I was managing at the time. And I remember when there was a line of customers around that building, because everybody knew they were going to fail, and they were bringing, checks over to the bank that I was at, which at the time was very, very safe. I think everybody's heard the story about Dick Kovacevic not wanting to take the TARP money and, walking out, and Treasury basically forcing TARP, on some of the banks that didn't need it. And so, that bank was actually a really well-run bank at the time. So I did learn a lot of great things. And then as I progressed, so to speak, up the ladder, I saw that there were things that were not so great. And there was always certain things that I thought, oh, if I get to the next level, like I can fix this. If I go a little bit further, like I can help fix this. And it's one of those things to where you start to see that it's like, no matter how high you go, like even if you became the CEO, like John Stumpf, who was the CEO for Wells, like he had moments of opportunity where he probably could have changed some things. But unfortunately, he had people that worked for him that he trusted a little too much, and that decided to take a different course. And that really, unfortunately, ruined that institution. And one of the things that I really walked away with was it's like the Wizard of Oz. Like there is no one at the top, whether it's the Federal Reserve, the US government, some of the biggest banks in the world. Like, yes, there are people there that are smart, but it's not like they know everything that's going to happen and plan for every contingency or every, conspiracy about how things are done. Sometimes it comes down to bad luck too, like we talked about, where they just happen to choose a direction and then things snowballed out of control and they didn't stop it. And it's like the Wizard of Oz. When the curtain gets pulled back, they're just trying to do the best they can with the information that they have available. And sometimes they don't make the right call. We're all human. We don't know what's going to happen. And so I got a pretty good lesson with that. And that's where I think has helped me in my investing career. Kind of like the Fed talks right now about like, oh, well, we're going to leave rates high for a long period of time. They don't know what the hell they're going to do. Last year, they were talking about, oh, we're only going to raise rates once, was on their forecast. Like, look at them now. They raised like 7 times. So will they probably leave it higher? Yes. But, now Fed fund futures are outrunning even the Fed forecast. They have no clue what they're going to be doing a year from now. They were talking about printing infinite amounts of money. And now they're talking about, being tight until 2024 or maybe even longer and all kinds of stuff. No one really knows. Like everybody has their forecasts and everyone tries to take in data that they can and then make a good decision, but no one really knows what's going to happen. And so that's something that I learned as a senior vice president. I was managing over 500 people and a couple $1 billion in deposits and over $1 billion worth of loans. And you just have to do the best that you can because you never know what's going to happen. And there's no one behind the curtains like pulling all the strings perfectly. Sometimes they're just as lost as everybody else.
Well said. Yes, absolutely. I see you from being on the inside and seeing how these high level executive officers still didn't really know what was going to happen the next few months. You take that experience that you had and you apply it now to the markets and saying, you know, the Fed, they may act like they know, but they don't know what they're going to be doing in 3, 6 months down the road. And we take that information and we act accordingly with our trades. And we know that we have to make decisions in a very uncertain environment. We don't know what we can't predict. We don't know what's going to happen. And like you said, the Fed said, oh, we're only going to go up, 1%. And then here we are, I think like over like 4% in just the past year. And we went from zero now to like, I think we're 450, something like that, 475, something like that. And we're probably going to be going to mid fives, it appears. I think they just re-rated it. The December Fed funds rate, I think, is about mid fives right now. So we have a very sticky inflation issue. It doesn't seem like it's going away anytime soon. Services are a function of employment and labor. We have a tight labor market. Lots of factors going on. We're not going to get into all that macro because we got all this other juicy stuff to talk about. And so tell us, Robert, when did you begin trading, whether it was part-time while you were working? When did you begin any of the long-term? I think you said you had started with the investing. When did this all begin for you?
So probably, gosh, I started investing. I mean, immediately when I started working for the bank, we did have a 401k. And so I started doing that throughout 2000, probably 2005, six more heavily. I was pretty lucky from a standpoint of I was young. I was making really good money for my age. So I was I had a boss at the time. His name was Brian Wong. And I got to give him this credit. And every year when you would get a little bit of raise, he's like, if you don't need the money, just take that raise and increase your 401k. So if I got a 3% raise, I would put 3% more into my 401k at the time. So that's what I was primarily using. I did open up a little TD Ameritrade account, I think in 2005 and six. Starbucks was something I invested in. Apple, I owned Apple for a very long time. Verizon because of the dividends. And then in 2000, I think it was 2006 or 7, I traded my first option. So there was a regulation that they had thought about passing. It was either K or X. I can't remember which one. But the bank wanted all the managers to get our Series 7 license while we were still doing our jobs. And so I was doing that training and I was learning about calls and puts. Like the options were probably the most difficult thing for me. I think anyone who initially starts to learn about options, it's just very confusing because you can be short options, you can be long, and like a short put is a bullish position versus a put that you're long is a bearish position, etc. And then you have the each contract controls 100 shares, all that fun stuff. So I do remember the very first option that I bought was like a Pfizer call, and it was out of the money and it went to zero. It went to options heaven. But then I got interested in selling options. And I bought a book called Get Rich with Options, I think it was. It's pretty old. I don't know if you can still find it. You probably can. And it's pretty old, so the examples in it are not the greatest. But it was actually pretty good from a teaching standpoint. And then I started selling credit spreads. So I think one of my first credit spreads, I want to say was on Netflix, where I should have just gone long on the shares of Netflix, like all the way back then. Versus a credit spread. And then in 2008, like when all the banks were tanking, because within your 401k, you can kind of move the money around a little bit. I think Wells was down to like $8. And I stuck my entire 401k in the bank because I knew it's like Wells was not going to go under. We were being forced to, the bank was being forced to acquire Wachovia at the time. And the strength of the bank was good. So I put my entire 401k into Wells, and that ended up working out for a long time. Obviously, after a while, I diversified that. And I still remember there was a banker in my branch that he took like his entire life savings and put it into Bank of America, like $2 or $3. Like I remember this day where everyone, like the market was just flushing. And everyone that worked there was like, we're going to buy, like, we're going to move all our 401k into the bank because, this is getting ridiculous. Obviously the Fed was, helicoptering. That was when Ben Bernanke, I think, created the helicopter money strategy into the market. And Fannie and Freddie, went to conservatorship with the US government, which they're still in, by the way, because they're not solvent. And that's why we have the type of mortgage, situation that we have versus like Canada and some of these other countries that have a lot of adjustable rates and things like that. So yeah, I remember those times like very relatively vividly, I guess, for now, being like 14 years ago, which is pretty crazy to think about.
Absolutely. Wow. I remember 2008 quite vividly myself. I was actually commercial real estate broker. I had my own brokerage. I was in Seattle, actually not too far from you. And yeah, I remember WAMU, and I remember Countrywide, and I remember all those companies. And yeah, we were right in there, and I was in the commercial side. So it was a little different. It was a little more, conservative lend. It's more conservative lending for the commercial. You'll have much lower LTVs than you do with the residential market. But yeah, I mean, it was still affected everything. And I was trading back then as well. And I've been trading actually since 2000, on and off, not full time, because I'm a serial entrepreneur. I have businesses, I run businesses. But I hear you say the word options gets me excited. I am also an options trader, and being a mathematical person, I love all the different multi-variables involved with options. And you mentioned the option writing, which is what I prefer. But of course, I think we all start out with those long calls, the naked calls. I think that's the gateway for everyone. So, I think we should dive right into your trading style and your investing style. But I think we should begin with options. Options have grown in popularity significantly since 2020. However, unfortunately, not as many people go that extra step like you did, and you're an autodidact. You've learned all on your own, which I give you credit, and that's amazing. I also have learned options on my own. I didn't have a mentor. And so I have quite a few option books. It's funny how they get rich quick with options. I have, what is it? Using Options as an Investment Strategy. It's this really big book. I have that, and there's a few other options books. But so please tell us your option strategy and what you utilize for your options, what your preferred time periods are, what you look for, how you use the IV and delta, theta, all those kind of variables, please, Robert.
Yeah, fantastic. Thanks, Rosanna. So options, I mean, I love, obviously coming from a banking background, insurance is a lot of financial services. Companies offer insurance, and it's just like a pure moneymaker. Options is the exact same way. So options were originally designed as insurance contracts. And so if you wanted to buy insurance on your stocks, you would buy a put, kind of like you would buy car insurance. But the cool thing about options is if you have a car or you have a home, like, you have to have car insurance and home insurance all the time. You don't always have to have stock insurance. Like, you can only put it on when you want to, which is kind of cool. And most of the time, your premium that you pay, your auto insurance, unless you get in a car accident, or your home insurer, that premium expires worthless, and the writer of that contract takes the money and makes it. Now, sometimes those insurance companies do have to pay out. And so that's generally the side of the options market that I want to be on, is the insurance company. So usually it's via put writing on companies that I like, that I'm willing to own. I'm willing to get paid, quote unquote, to be patient. It started off as credit spreads, because when I first started trading, I didn't have a very large account. Now that my accounts are much larger than they were, I can do a lot of like naked, or, if it's in like a retirement account, a cash secured put, to where I can get paid to wait to buy that stock if it, quote unquote, crashes. And so a lot of times I will look for multi-down days in a row, when a stock really, I wish I had like a rubber band around here, but a lot of times when there's just rampant selling and the stock price, starts going lower and lower and lower, that rubber band gets stretched. And so at the money options, the volatility starts to explode because the market makers have to price in how volatile that option is. Well, that options premium, that volatility expansion goes across the entire options chain. And so if I can sell options far away from a strike price, from an at the money, let's say, near strong support levels, areas that I wouldn't mind owning stock. And generally I shoot for like 1% of the stock price. So one of the last ones I sold was I had sold some March Tesla 145 strike puts. And I sold them for $1.45. So that's
And
1%.
what was Tesla trading at when you sold them? Just to give everyone an idea of how far out of the money you went.
I think it was around like 190 or maybe around 200. It was like a multi-down day that it had, and it had started to retest a little bit. And yeah, Tesla has very good premium. Like even
Beautiful. Love it.
When it was really down, like around 100. I mean, I was selling 70s and 80s. I'm like, give me
Wow,
Tesla
that's
down to
very
70
safe.
and 80.
Absolutely, that's
So
very safe going that far out of the money. Very nice. And the premiums pay for it. It's very nice premiums.
yeah, and if you can get 1% a month, so now it's a little different because there is a risk-free return in the market for cash. But before, when there wasn't, if you can get 1% a month, if I set aside, I don't know, let's just say $100,000 I set aside. I'm like, hey, I'm going to shoot for 1% a month. So that'd be $1,000 a month. If I can do that over the course of a year, that's a 12% return. Now, sometimes insurance company, you got to pay. So sometimes you got to buy those shares if the stock, comes down to that level. And then, I'll use a type of wheel strategy. I'll sell, depending on how bad I want out of the shares. Sometimes I'll sell like calls right at where I got put. I actually did that during 2020 when the market was crashing with a bunch of SPY. I got put a ton of SPY at like, I think it was 240 or 245. Can't remember the exact amount, but I got put at 245. I think it was 245. I got put at 245 and I sold calls and got called away at 245. But I made $5 a share buying and then selling the shares of the SPY for the same amount of money, for the same dollar amount. So you can really profit off of that. Again, it's not as profitable. You're not going to see, oh, I got 1,000% return, like some of this zero DTE, craziness, but it's steady. It's relatively safe. Again, the stock could just keep crashing and you could lose. So you have to make sure that you don't write a ton of puts that you can't afford to get put, because you can get put all those shares, 100 shares per contract. And you don't want to be on margin with, thousands of shares that you can't afford. So it's all about sizing.
Absolutely. You talk about risk management is key. And, when you have cash secured puts, I love that strategy for collecting premium, and you can collect it monthly. You can choose your favorite stocks that you would own. And then you go as far out of the money as you did. And in my opinion, that's very safe. It's very doubtful, in my opinion. Of course, we never know what happens in the market, but to go that far low, it's unlikely that it gets put to you. In the unlikely event that it does, hey, I don't mind owning it at that price. And that's how I say to myself. It's like, oh, would I own this stock at that price? Yeah. So I sell those puts. And yeah, it's about being temperate and not going overboard, and it's having balance. And you don't want to sell more than you can afford to buy. And you said it right. You want to have enough that in case you get put those shares, you don't want to be on margin, especially not in this environment. So very, very important point, to always keep that risk management in mind when doing all these trades. And then you mentioned one of my favorite strategies, the wheel. And that was a smart strategy that you did, the 245s going like that. It's you weren't greedy.
Looking back, I should have just held all those shares of the SPY, because but
well,
I mean, again, hindsight's 2020. Yeah, like who knew that we were going to go to 460 or wherever
right?
it went. when, the world was shutting down and we thought everyone was going to turn into Corona zombies. So
Exactly. Well, that's I give you credit for that to think of risk management. And it's better to be safe, and you got them called away, you made your profit, and it's about making those consistent gains. It's like lowering our risk, the risk per reward, and increasing our probabilities of success. So it's better to keep compounding those smaller wins than trying to hit those home runs. Like you said, the 1,000% return. I mean, especially in this market, you end up, in my opinion, losing more than anything else. So yeah, I love the short puts myself.
And one other, before I forget, sorry to interrupt you there. One secret that I will kind of give away. So I know I had posted on Twitter today, like, oh, I'm old enough to remember when T-bills, weren't sexy. There's some great strategies that you can use. Treasuries are actually marginable. I don't know if everybody knows that or not, but you have a margin account. So like with TD Ameritrade, I could take 100 grand and I could go, hey, I'm going to put 25,000 a week in 4-week T-bills. So you would buy it for whatever it's going to be. I think on 25, it's going to be like 24,800 or something like that. Yeah. But the margin that is going to be held at your broker is only 1%. Well, right now with TD Ameritrade, it's 1%. When it switches over to Schwab, I think it's going to be like 3 or 4. So in the meantime, and again, you don't want to go like onto margin, like negative cash. You can take that cash, you can buy weekly T-bills 4 weeks out, spread that money out, sell puts also, which again, if you have margin ability, it's holding less buying power. And then if you do end up getting put shares, you know that you have that cash maturing, after the first 30 days, you would have it every week maturing. So you can kind of stack some of that to increase your yield. And that way you don't just have cash sitting there just waiting to sell the puts. You can roll that in like T-bill ladders every.
The ladders. I love the ladders. That's great. You have them maturing in a certain schedule. Very smart. I love that. I take you utilize TD Ameritrade right now?
Yeah, TD Ameritrade primarily. I do have a like backup broker, so to speak. So I have multiple accounts. So I have my long-term account, retirement stuff. And then I have my LLC trading account, a separate little personal account, a Roth IRA. And then I do have a backup broker, or also I use it for day trading a lot with Interactive Brokers. And that's an account that just goes to literally it's cash every day. At the end of the day, it's always cash. And that way, let's say I have, I don't know, shares of Square or Block. Now, dumb name change, but say I have shares of Block in all my accounts, but then I want to day trade it. I can just flip over to Interactive Brokers and trade it over there, and it doesn't mess with my cost basis or anything. So Interactive Brokers, TD Ameritrade, which is soon to be Schwab, they're starting to rotate some of those accounts over. Those are the brokers that I primarily use. Yeah.
Awesome. So do you also utilize covered calls on long shares? And I was going to ask you about your long-term next. So let's go right into options with your long-term strategy. Tell us about what you do there.
Yeah, so I love covered calls also. I know, again, nothing that I'm mentioning is financial advice, by the way. I'm not licensed right now, and I don't want to be, and I don't want to be your financial advisor, whoever's listening. So this is not financial advice. But I look at covered calls, like if you do them properly, they're win-win scenarios, because if I get called away on something, let's say it's, well, I got Tesla on a screen here. Let's say I own shares of Tesla and I bought them at 150, when it was crashing, and then I'd sell a covered call at 200 and I get called away. I'm not losing, right? I bought lower, I sold higher. Like, yes, I'm capping my upside, but that's not a risk in my opinion. I know some people look at it that way. Or if the call expires worthless, then, hey, I just made money and I can do it all over again. And that helps increase your returns. And this is one thing where when people say like, oh, it's really hard to beat the market, I can give you one specific area it's actually super simple. All you have to do is own VOO, VOO, which is the Vanguard S&P 500 index, or SPY. I think it's like an extra $3 worth of management fee per 10K. And you sell one covered call over the course of a year that expires worthless, or you buy it back. at 50% capture or what have you, which is not hard if you can do like a couple things with timing. But if you just do that once, you beat the market because you were in the market, which obviously a lot of people's benchmark is the S&P 500, and you got the whatever call premium and you beat the market.
Yeah, I like that. Very nice. Yeah, because you get that premium on top of that SPY. I actually have SPYD. That's the high yield ETF on the SPY. I always talk about that one often, but I like VU as well. Excellent points that you make. I love that. Yeah, we have a disclaimer here because I actually passed my Series 65 and I'm in the process of probably moving forward with that. But yeah, absolutely. Nothing here is financial advice. Agree. We're sharing great ideas for people that they can explore with their own financial advisor on their own. So yeah, covered calls. You know what's Tesla is an excellent example. It's a highly liquid stock, mega cap. It's a great high volume, excellent premiums. There are quite a few high premium stocks out there, high IV. I actually have been trading Enphase for quite a while. I got in July 2020. And so I've been selling cover calls on that for quite some time, not full time. It is very volatile, but I've been very successful with that. And I've sold puts, I've done spreads, very lucrative one as well. To me, it's like when you talk about Tesla, it's similar with the high premiums and very liquid as well. So there's a lot of stocks out there. There's ETFs. I love that point you raised about the T-bills at TD Ameritrade. Because right now, I mean, I think it's like 4.6, 4.7%, something like that. It's over 4.5, let's say that. And I've been utilizing T-bills through Treasury Direct. I've been going there. But what a great idea to go to TD Ameritrade with the ladders. So I like that. And then you can utilize the margin, like you said. Great ideas there.
Yeah, if it's in an IRA or something, it's not marginable. So if you buy, 25,000 worth of T-bills, like they're going to put that amount on hold. But if you do have a margin account, it's marginable because they know they're going to get their money, right? Like it's not,
Could you tell everyone the ticker that you would use for that?
So you'll just you would log in. You can't do it through TOS that I'm aware of. So just go to the TD Ameritrade website. Go up in the top right hand corner. There's a search bar. Type in new Treasury issues. You'll pull up that new issues, and it's every Wednesday. So like today, I put in my bids, so to speak.
Yeah, the bids.
4-week Treasuries, and then I'll just again roll them every week. And so I have like 4 to 5 sets depending on the week and the month. So every week a set's maturing, and then if I need the cash to do something else with or reinvest in something, I can do that. And if not, it just keeps rolling. And again, there's a risk-free return now, which there hasn't been for a long period of time. There is even ways, like I did this trade in December, and the folks that are in my Discord, I was showing them, again, what I was doing, not advice for them, but I was showing them, I was like, if I could just make it easy, $25,000, I could buy a 1 year, like 1 year and a week, right? So that way you're over the long-term capital gains. You can buy 0 coupon bonds that the 1 year at the time, I think was right around 4.6, maybe 4.7. It might be a little bit higher now. But basically you could buy a 0 coupon, 25,000 face value bond for about 24,000. Might have been like 20,000, 23,800 or something. So when it matures, you get the 25,000, the face value in a year and a week. And then you take the difference. So you take the difference of that, like $1,000, $1,200, and then you can buy a call spread on the SPY. So you could literally get yourself in a position where you're not going to lose. I'm not going to lose any money on this trade. There's no way I can lose money, right? Because I took 25 grand and I bought 25,000 face value, unless the US government defaults, which I guess right now is possible. But that's the most risk-free you can get. So you're not going to lose money, and you still get to participate in potential upside. At the time I chose SPY, but you could pick whatever. I mean, you could pick Tesla or anything, but you can literally put yourself in no lose scenarios These are what a lot of financial advisors will call like structured notes or structured products, which if you call your broker to do them, they're not as great because they charge you a lot to do that. There's like a fee that's built into the product usually, and or they like will take your dividends and certain things like that. So you can structure your own. Generally, you need a little bit like more money, like 25,000 is probably the minimum, because you need to be able to buy enough zero coupon bonds to then have the difference be able to buy you a good call spread or different. You could buy it. If you think the market's going down, you could buy a put spread. For like, hey, you're not going to lose any money, but if the market goes down, you can participate in 10% to the downside. Or I could say, hey, I'm not going to lose. I could sell another put too. So I could take that same thing. This is what I actually did. I said, okay, so I'm not going to lose any money unless the SPY goes below 250. Once it goes below 250, I'll start losing money. And so not only did I have the difference in the zero coupon bond, I also had the put sale premium for a year and a week of SPY 250s. And then I used all of that to then finance a upside bull call spread. So I bought a near the money call and then sold it out of the money call. And that's all a little over a year out. So that way, when that trade unravels or comes to fruition, I at the time was participating in about 15% upside potential with not losing any money unless SPY dropped below 250.
Very
So
nice.
it's like really great opportunities that people just don't even realize that you can do now. Now that there's actually a risk-free yield, it's awesome.
I know. I actually, it's quite refreshing to be back into this zone. It's been quite some time that we've been in the other way with very expansionary monetary system. And so now things have changed. I think, in my opinion, it'll probably remain this way for some time. They're saying higher for longer. Now they're saying much longer. It will take time, according to Deutsche Bank. Once inflation's over 5%, it can take up to a decade for it to come back down to 2%. So we could be in here for much longer than just this year or two. So it's excellent, Robert, that you're utilizing that to your benefit. You're using options with that. Love that all. It's awesome stuff. Let's see. We talked about your dividends. You said the word dividends in there. So I think it's important that we touch upon the dividend plays as well, in addition to the options, as a great way of having passive income. So could you tell us what you look for, and if you are someone who acquires these dividend stocks for long term?
Yeah, I do like dividends. I mean, right now, I want to be, since there is a risk-free yield, like if I'm in a stock that doesn't have any dividends, the only way I'm going to make any money is if it goes up. Well, I do think that I don't think we're going to have another crash like we did last year. But that being said, I don't think we're just going to rip to all-time highs or anything. And so I do want to have stocks that are hopefully paying me a dividend. Not all of them that I have are, but that's always a benefit. I think that dividends, I know you mentioned earlier that word of passive income. I think that dividends and like interest payments are really actually your only real form of passive income.
That's what I say all the time. Exactly.
Yeah, like real estate is great, but it's not passive. It can be less time, depending on how you do it. If you manage a property yourself, obviously it's a little more time than if you pay someone. But there's still some time that you have to put into it. Whereas with a dividend, let's say I buy shares of, let's just use Warren Buffett. He owns like 400 million shares of Coca-Cola. He doesn't have to run Coca-Cola. He's not putting Coke in cans. He's not managing the facilities. He's not doing any of that stuff. The business runs, and then he gets a check in the mail. Like, that's it. So I think that from that standpoint, dividends are really like the only true passive income out there, other than like interest payments, which are very similar. So I want to be in companies that are profitable right now. I don't want to be in a lot of companies that are losing money, because as they do have to, and when money was just raining from the heavens the last few years, a lot of these companies that have business models that aren't profitable didn't matter, because it was very easy for them to go get new money. Well, where are they going to get that money now? You can't really do equity raises. Like, we see how well that goes over. You're not going to be able to go out and raise it in the bond market for very cheap, like you could for a while. And so you have to be cash flow positive. Your business has to be generating income. So I want profitable companies. Hopefully they share that profit with their investors. Dividends are also taxed at a much lower rate. I know a lot of people think like, oh, taxes don't matter. Like taxes matter. They're probably not probably for most of us, they are our largest expense throughout the year is our maybe our mortgage, but taxes. And so dividends are taxed at a lower percent. And I think they're great. And especially if you have dividend reinvestment plans, like a drip turned on. I'm 39, I turned 40 in May. So I still have a lot of time left. So I do want growth, but at the same token, there's plenty of time for something like Johnson and Johnson, Verizon. Some of the energy plays I think have pretty strong dividends right now. Devon has a pretty strong dividend. Chevron, XOM, those types of plays that a lot of the energy companies have good, strong dividends. And then hopefully if you get some share appreciation too on the upside, like that's awesome as well. But yeah, I do have dividend plays in my portfolio because I do like to pick stocks too. I do have a lot of my longer term money is a little more like indice focused. And then I kind of have like satellite positions, like 5% of my portfolio for this or 5% for that. Usually I don't go over 5% of my portfolio for one particular holding. But I do have some of those that it's like, I like the dividend and that's why I'm in it. Same with some fixed income now. Like if you, again, not financial advice at all. I'll give you an example of one that I bought. So I bought some Carnival Cruise Lines bonds. I bought them for, I think it was 68 cents on the dollar, and they have a yield to maturity of like 12%. So not only, as long as Carnival doesn't go bankrupt, I don't want the shares because they don't pay a dividend. And if they do go bankrupt, I'm definitely going to get nothing. If I'm on the credit side, if they do go bankrupt, hopefully I'd get a little bit, maybe I get 10, 20 cents on the dollar or something like that. But I have potential face value appreciation when that bond matures. And I have the interest payments that happen semi-annually, so twice a year, where I'm not running the cruise ship. I don't have to do anything except put money at risk. And then they make a payment to me every 6 months. So like that's how I play that one. So there's definitely some room. I don't want to be a ton of fixed income because I am, I can't touch an IRA for another 20 years, but there's great opportunity out there, like for fixed income and for treasuries and dividends and all kinds of stuff versus some of these, the last couple of years, there's a lot of this junk that's just like, I don't know, Teladoc, Fastly, like they don't make any money. I don't know. Are they going to be able to survive?
Yeah, the ARC ones, the innovation is the key to growth. I'm glad you mentioned that. Yeah, they have, I talk about this quite often. I tend to be more of a fundamentalist. I'm also technical, but fundamentals are my forte. I was a CFO for many years and I'm a math person and everything. So I love that you mentioned, thank you so much for all your excellent points. I have to tell you, Robert, you know so much and it comes from, and I always tell people this, it's hands-on experience. I went to business school, I got my MBA, I was in graduate programs in decision information sciences. And I got to tell you, they teach you perfect scenarios from textbooks. They don't teach you real world. Yeah. And I think schooling is excellent and I love it. And you learn so much, but there's nothing like hands-on in business. And you have the banking experience. So you're familiar with these bonds, fixed income, zero coupon. I love that you mentioned all that. Those are all diversification for, across different asset classes, which I think is important, absolutely, for portfolios. You shouldn't be in all growth stocks. I mean, that's my opinion, not financial advice. We're going to keep saying it, but the point is that, when you structure a portfolio, you put 5-10% here. Like I believe that gold is something that, I like to have maybe 5 to 10% of my portfolio or less. There's also inflation protected ETFs, which are great. A friend of mine, Nancy Davis, she has 2 ETFs. She's an amazing woman. She actually has one that's orchestrated that way. She's specialized. She's an expert in that. I am not. Amazing stuff out there. And then you mentioned these fixed income. There's so many opportunities. If you look, I love that idea with Carnival Cruise Lines bonds. Yeah, you definitely bonds, being a creditor, you get paid before, if you have, preferred shareholders and, common shareholders. So I think that's smart. I think the way you've organized that, I love that. I'm gonna go back to cash. Cash is king. Like you said, we're receiving, we have real yields. We have, when we have T-bills, which I like the 4-week as well, I'm all about liquidity. You pay for that liquidity. So I'd rather have the 4.6, whatever it is, and have that 4-week, like the ladder, have them maturing every 2 weeks is what I have. You can do it weekly, whatever way you orchestrate that. But having that money keep coming available, you have your cash working for you. And, to me, it's important when I look at companies. I love that the dividend yield is important. Make sure they're historical. They haven't had a pattern of, eliminating or downgrading their dividends. But when you go with solid companies, like you mentioned, those are great opportunities. Free cash flow yields are very important when I look at companies, increasing earnings per share, margins increasing, like we saw for the earnings last night. I'll just bring it up briefly. When I see, I'm no position there. When I see they have increasing margins, and their earnings are higher, guidance is higher, that's key to me. And especially in these contractionary times where margins are compressed, we know that higher cost of goods sold, operating expenses, we have higher cost of production, labor. Oh, big one, higher costs of debt and capital. Like you mentioned, TDOC, all these companies with ARC. Well, how are they going to get their money if they're not generating profits? They're going to have to keep doing that constant refi at higher rates. And then they're going to have to keep diluting that equity. You think these shareholders are going to be happy in these economic times? So there's going to be a lot of issues. And I know some economists are saying, and you being a banker in your past life, defaults could be incoming. There are a lot of issues. Are you concerned about, because you have that experience, Robert, and you bring so much to trading? Do you think in those terms that there could be something major that can happen in the near future, maybe 6, 12, 18 months from now?
Like as far as a big credit event?
Mm-hmm.
I mean, there's always a possibility. So like, I know you mentioned earlier, my comment about like, it's about probabilities, not possibilities. Like there's
Yes.
always a possibility, right? Like I could go drive to the grocery store and die in a car accident, but obviously the chance is pretty low. And like, even if I get in a car accident, I'm going to wear my seatbelt, things like that, et cetera. So there's always what's called in the financial services, like an investment tail risk. So that's like, if you look at a bell curve of probabilities, the small sides on each one, that's like really low likelihood of happening. That's your tail risk. And so there definitely is always tail risk that there could be out there, some type of massive credit event. I think if there was going to be one, it would probably come from Europe, probably somewhere like Deutsche Bank, Credit Suisse. Like the European banks are an absolute disaster. They never fixed themselves after 2008, 2009. As far as on the US side, I don't really think that there is a risk of a large credit event from a bank. I do think that there could be some smaller, like if Teladoc goes bankrupt or Fastly, hell, like let's say Uber goes bankrupt eventually. I'm not a big Uber fan. I like
How
the
about
service.
Lyft?
I
How
don't
about Lyft? Not Lyft either, right?
either one. Like I like the service. I don't like the business because it doesn't make money. Anyways, if one of those types of things fails, like I don't really think it's going to impact. There's no like systemic risk that I see from that standpoint. The market will, yes, there'll be some people that lose money, but the market can absorb all of those types of things. That's not like Lehman, like everyone that thought last year was 2008, like just goes to show me that they didn't understand what 2008 was about. Like
Yes.
2008, we were literally on the verge of the entire financial system collapsing. Like there is not that systemic risk now. It doesn't exist. So I think the banks are actually probably really good from a investment standpoint, because what happens to their net interest income and their net interest margins every time rates go up? It's just like cha-ching, like Jamie Dimon was on CNBC, like talking about 6%. Like he would love 6%. You know how much money he's going to be making at 6%? And yes, there's a risk that people are going to default, whether it's consumer debt like credit cards, or businesses like, I don't know, Carnival Cruise Lines or Royal Caribbean or something like that. But those little one-off things, like, yes, I do think that there's more likelihood that that type of stuff is going to happen, but it's not really going to make a large impact on the market. It's kind of like crypto. Like crypto could go to zero tomorrow and it's not going to matter to the overall financial system. It's just not. It's not big enough. I definitely feel bad for people that got bamboozled in some of those scams and things, but it's not really going to make a big. It's not going to make a big dent in the financial system. So I don't really know where that risk would come from. That doesn't mean that it's not out there. I'm not saying I know everything. I think the biggest L that's been taken is probably from the Fed. Like they bought all those mortgage-backed securities as they were easing, and obviously rates have gone up. So what has the value of those mortgage-backed securities done? They've tanked. Well, who's taking that loss? The Federal Reserve. Do they mark to market it? I have no idea. Probably not. I mean, that's one of the things that caused the 2008 meltdown is a lot of the institutions had to mark down these losses before they even happened, so to speak. That doesn't really exist in the U.S. housing market. Yes, there's some leverage, like there always is, but most people are locked in on very low 30-year, 15-year mortgages. Like there's not going to be a massive wave of foreclosures. Maybe some people that over leverage with Airbnbs and things like that. And then even if there is, what I'm noticing, I do have my real estate license here in the Boise area. And so what I'm noticing is it's just like stocks. As the market comes down, there's buyers waiting. They got limit buys out there on homes. Like, let's say 325 grand. You couldn't touch anything, any single family house for 325,000 in this area. Well, now that it's starting to come down, like as soon as it comes down there, boom, they get bought up. So there's buyers down there waiting that it's like they got to chew through in order to come down lower. And BlackRock had stopped buying houses in certain areas. Now that the market's pulling back, what do you think they're going to do? They're going to step in and they're going to start buying again. The builders learned from 2005, 6, 7. They did not overbuild dramatically across the country. There's a shortage of housing. I actually think the bigger risk is probably on the commercial side with like a multifamily, because a lot of those deals, they're not fit. Like a lot of people don't realize these are not 30-year fixed loans. A lot of them are maybe, fixed for 3, 5, 7 years. As those have to be refinanced, maybe there's some issues there. But again, I don't really see that. Like eventually it would bleed through, right? Like if a lot of apartment buildings went under or what have you, then and those values came down, and obviously that can impact rents, and then people would just buy and that kind of thing. So you can always bleed through to the housing market, but I don't really see one of those giant events outside of some type of like a country defaulting or something. Like, yeah, there's definitely risk if the U.S. decides to not raise the debt limit, but we all know they're going to.
Yeah.
Even if they wait till the last minute, they're just going to kick the can down the road. I mean, we are literally testing the limits of modern monetary theory, like live while, we've been watching it the last, if you look at M2, which is the measurement of money, the money supply increased like 40% in 2 years. And last year was the first time, I think in like 60 years, that M2 was actually negative, and it was only negative by like 1.5%. Inflation will win. It's just a matter of whether or not they change the way that they calculate it or they change their target. And even this is the other thing that people think when they think of inflation. It doesn't mean the prices stop or start coming down. It just means that they stop going up.
Exactly.
Like, oh, well, it didn't, your groceries that were $50, like they just stay at $50. They don't go up to 51 or 52. Like they're not going to go back to $40 per trip that you had last year. Like it's not going to happen. there's no way that we can print the amount of money that we need to print in order to keep everything going. We're $30 trillion in debt and even more with unfunded liabilities. So inflation will win in the long run. It always has. It's just whether or not they measure it. I mean, we changed the definitions of all kinds of things. So we'll just change the definition of what inflation is and how it's measured.
Yeah, you made a great point. Inflation is cumulative. And, just because we see it decelerating, doesn't mean that we see the change in the prices. And that's a very important point. Inflation is basically a result of mismanagement. And there was mass spending that occurred. And at this point, I mean, there's three ways to curb inflation. We have raising rates, which we're doing. We also have to reduce the quantity of money, which is through tightening of credit, reducing balance sheets. And then the third one is to reduce government spending, which the government is not reducing their spending.
Yeah,
and we
not
know
going to
that.
happen.
No, and it's about 50% of GDP. So there are a lot of issues there. Thank you so much for your valuable input from a banking experience insider. I agree with you completely. The GFC, the 2008 was a banking crisis. Now, homeowners actually have more equity than they have in the recent past. Also, a lot have locked into lower rates. Plus, as a result of 2008, there are much stricter guidelines with lending. So we're not going to have that same issue. I know people always say history repeats, or they always go back. It's an availability heuristic. It's one of the biases that humans use with their thinking. And they say, oh, it's the first thing that comes available in their memory. They think of 2008. Oh, we're going to have a massive crash. My opinion, just like yours, is that it's probably going to cool off more. And we needed some cooling off. We'll probably, hopefully, we can get some better pricing. But as of right now, what I'm seeing in the real estate market, and I think this is a perfect segue to go into the real estate market discussion, is that, like you said, they're like support levels. There's like a bunch of buyers waiting. And as soon as it comes down to a certain point, just like in the charts, we see a bounce. And the same thing seems to be happening with housing. In my corner of the woods here in New York metro area, I'm about 40 minutes or so outside the city, we're noticing historical low inventory levels. Now, that's a result of a few factors, like you touched upon, people locking into lower rates. So they're not willing to sell. And they're like, oh, I'm going to have to sell my 2.5% or 2.7% mortgage. And now I'm going to have to pay a 6.5%, 7%, whatever it is nowadays, maybe even 7% mortgage. I think it's in the sixes. So, I mean, that's significant. So I'll just hold on and I'll wait through it. Plus, there's a rise in remote work. So people aren't needing to relocate due to work as much as they used to in the past pre-COVID. So we're seeing home sales have come down, but home prices have actually held pretty steady, at least in our area. We were appreciating for a while. So we're far from it. I think that there should be some type of more cooling off, but who knows what's in store. So let's talk about the real estate market. What are your thoughts? Are you a commercial investor? Do you do 5 or more units? Do you do more of single families or duplexes? Give us your thoughts, your experience of what you do, what you enjoy doing.
Yeah. So obviously I mentioned earlier that I moved to Arizona in 2009. So this was like right as the financial crisis, housing crash had already taken place, and things were like starting a little bit to recover, or like bottoming out, I guess you would say. So I was pretty spoiled and I guess, lucky, so to speak, that I was making good money at the time. Housing was really cheap. Arizona, they built like absolute crazy. Like there was a town called Maricopa.
Oh, yes.
And are you familiar with it?
Yes.
So yeah, there would be like a fully built house, like stick house, halfway built house, fully built house. And they just abandoned this area. And you would be buying like 3,000 square foot houses for like 50, 60 grand. And if you were a first time home buyer, we're getting the Obama, it was like $8,000 credit or whatever it was at the time. So there were like tellers that worked for me that were buying like big old houses. There was a lot of really great opportunity. This is another reason why I don't think there's going to be a huge housing crash, especially in single family. Everybody remembers that. And what does everybody say? They all say, I wish I would have bought more. I wish I would have leveraged my whole life. If I only knew then what I know now. And so it's still fresh in their minds, even though it's 10 years later, because look what housing's done. And so when people see that, like they're going to start snatching things up.
Yes.
And there is still, like, if you just look at reverse repo, so this is where banks and other counterparties, hedge funds, some foreign governments that have access to the reverse repo market, they take cash and they say, I don't need this cash. I'm going to put it on deposit with the Federal Reserve. This is one way they're tightening liquidity. And then the Federal Reserve will pay them an overnight rate. Well, it's like 4.57%. There's zero counterparty risk because the Fed's going to pay you. There's over $2 trillion sitting there, but the Fed is basically holding hostage by every day we have a Fed speaker like out there saying, we're going to keep rates high. We're going to keep rates high. This is part of how they keep things tight, is they're holding that $2 trillion hostage for 4.57% or whatever it is. If housing starts to drop and that $2 trillion, people are looking at it and go, you know what? Now there's more opportunity in risk assets, like whether it's stocks or housing, in this case that we're discussing, they're going to put that money to work. There is so much cash on the sidelines because we printed, trillions of dollars, and then asset prices obviously went up more than we printed because it was this huge inflationary cycle that has not all burnt off, and the Fed is not going to be able to burn it all off. Like it's going to stick around for a little bit. Yes, they're working on it, but you can look at their balance sheet's like barely moving. It's never going to go back down to where it was. It's like the genie is out of the bottle. It's not going back in. And so asset prices I don't really think that housing is going to have a huge crash like that. But single family is what I like. And so I do think there could be a little bit more of a pullback. That's where I'd be a little more willing to put things to work. But as far as like apartments and things, I was actually just looking through some listings, and people are still trying to offer these things at like 4 to 6% cap rates. So multifamily, if it's over 4 doors, then it's a commercial property. They're not valued by like appraisals and things like that, like the house that I'm living in or that you're living in, or that people are familiar with. They're valued based on the net operating income, and then they're given a cap rate, and then they figure out what they want to sell the property for. Well, who wants to buy a 4 or 5 or 6 cap when I can literally buy a CD for over 5%? Like a local credit union here, 18 month CD is like 5.2%. So it's like, why would I buy a 5 cap apartment building where now I got to pay someone to operate the thing, or I got to deal with tenants and toilets.
Yeah, and then deferred maintenance, and don't forget about that, and all the other headaches involved. I know.
It makes it tough right now. Again, I love real estate. I like all forms of investing, really. But right now I just don't see that there's like really great deals out there yet. And I hope that there will be a little bit better. But I think rents are probably going to start coming back down a little bit. And that'll also, again, the way the Fed measures inflation with rents is kind of dumb. But I think that'll put a hurt.
Yeah, the OER, yeah.
That'll put a hurt on multifamily. And then the refinancing that multifamily is going to have to go through in apartment buildings. I think that could be a little bit tough. So
yeah, excellent points. We have to factor in the debt service. Cap rates don't include that. So it's very important when you say 4 to 6% cap rates, then you put the debt service on top of that. Now we know that we're at much higher rates. So when you add that, you're looking at a cap rate that's barely nothing. And, it's so low. So I remember when I was a commercial real estate broker owner, back in 2000, I was going to start like 2003, 4, 5, that whole time period, we were talking cap rates 8 to 10%. Those are really nice. And that's what you're looking for. When you talk 4 to 6% with the higher cost of debt and capital, loans are tough to get, you get a low LTV, and then you have higher rates, it's challenging. So I always look at the cash on cash return, and that's what I always talk about. So like you said, when you have passive income, with these, getting, T-bills, 4-week T-bills at such a, you basically just go, you buy them at a discount, and then you get your full value, your face value, in 4 weeks for doing, what do you do? Nothing. You're really, that's like passive. That it's about being smart. And, that's great points there. Do you look at CLOs or CMOs or anything like that? Do you have any interest in that with the tranches or anything?
Not particularly. No, not particularly.
Okay. Yeah, that's just another asset class that I was reading about. Some say that you could find some good deals in there as well. I haven't explored that avenue because, like you said, I just like the T-bill 4 weeks, and there's also the floating Treasuries ETF, or you could just do money market funds. There are a lot of options on all that, and it's about I always say, I call it return on time. And so, the kind of money you make on how much time you put into something. So like, 4-week Treasury, how much time do I put in there? Well, I click and I transfer the money, and that's it. And then it comes to me straight to my bank account from Treasuries Direct 4 weeks later. So
Yep.
very, very, very nice trades there. So your ideas on real estate market. If, let's say, someone wants to buy real estate, someone's looking to buy, you would probably say it probably maybe 6-12 months out the window. Maybe that window right there would probably be better pricing, or you think that, what are your thoughts just to wrap up the real estate issue?
Yeah, so I do think that, well, it really depends on everybody's situation. So if you need somewhere to live, like, you got to buy, right? So, and if you have cash, that's ultimately going to be better, because with housing, you have to also look at what's called like affordability. So most people can't pay cash for a house. They have to finance it. And even as prices come down, if rates go up, your payments still up there. So if you can buy cash as things pull back, that's great. But if you need somewhere to live, you need somewhere to live, and you can always refinance later, because rates are not going to be, they're probably not going to go down to where they were before. But they're probably, not going to go to like 8-9% mortgage loans. I just really don't think that we're going to get there. But you never know. I mean, I don't have a crystal, I don't have a crystal ball. And so if you need somewhere to live, you got to do what you got to do. You can always refinance later. Like I said earlier with real estate, if you wait long enough, you will be okay. I mean, that's one of the good things about real estate is it's not liquid, and it's very difficult for people to see the value. It's not, I can go in. I have a real estate deal going on right now, and I'm like,
Ooh.
man, all this paperwork. It's like, I could just literally click a button on my phone and buy and sell $500,000 worth of stock with like one click.
Return on time.
Where it's like, there's all this paperwork for real estate. So, but that's a good thing, because a lot of people would probably take a lot of losses on real estate if it was so easy to just buy and sell it like we do stocks on their phone. Most people don't have that holding power. So it really depends on what you want to do. If you want just real estate investments, I do think that you could wait for some of those limit buyers as things come down to kind of chew through some of those people that have been waiting. And then as the next set, let's say, of inventory comes on and those prices start to come down a little bit more, then maybe you will be in a better position to like get a good deal, because a lot of times in real estate, you make money when you buy.
Yes, that's it. I always say that you make money when you buy. And
there's not really ways to sell covered calls, unfortunately, on houses. Like, kind of maybe a cash out refi, but not now when the rates are high. So it kind of just depends on what someone's goals are. But if single family, like duplex, triplex stuff, I think that you might be able to get a better deal in 3 to 9 months or so.
Nice. Yeah, exactly. Thank you so much for that. I like to talk about the market overall. And let's go into that. What are your thoughts on the market, the stock market? and what you're anticipating. Of course, we're not predicting, but what are your thoughts? Do you think it's a sideways grind probably for this year into next? Is that what you're anticipating based on your experience? And if it is a sideways, where there's really no feast for bulls and bears longer term, of course, short-term action, there's always action. How are you going to play that? What would be your strategies in addition to what you already discussed, like maybe iron condors, if you're a fan of that, the two credit spreads, and what indicators and fundamentals and what kind of puzzle do you use for your trades? Thank you.
Okay. So yeah, like overall, like, I've kind of mentioned a little bit, I'm not as bearish as like FinTwit and everybody, like every guest on CNBC, like, oh, we're going to 3,000 on the SPY. I mean, maybe, but at this point, like that's another 30% pullback. History just doesn't, if you look at probabilities, like how many times do we have years where it's like 20% down year, then another 20% down year? Like it just does not happen very often. So if you're betting on that, like history is against you. And it's not that, history like has to repeat itself. They say it often rhymes, stuff like that. But the market can still go higher while interest rates are going up. People think that it can't. But if you look like prior to free money, helicopter stuff that started, like as rates were going up, a great time to look at is back in the 70s when we had crazy inflation, and then Volcker started raising rates, inflation went up, came down, spiked again, and then he raised like to 20+%. And this is before I was born. I was born in 83. So I'm just looking on a chart.
You're a baby.
I don't feel like it. I'm turning 40 soon. But I didn't live through that area, but I'm looking at the chart. Once inflation initially peaked, and even though it came down and then went back up and then rates went even higher, the market had already bottomed. The bottom was in. I think we're in a little bit of a mix of that and the 2000 like bubble, but the market. This is one thing over the last year and a half, 2 years, I feel like I've grown a lot. I used to look at like SPY as the market and the indexes are the market. Like, yes, the indexes are important, but we really have a market of stocks, not just a stock market. So if you look at the market of stocks, the crash started in February of 2021.
Exactly.
And it started with things like Fastly, Teladoc, all of these, like quadruple my account in 3 months, kind of thing. And that's when those types of things started rolling over. You didn't really see it hit the indices or mega cap tech, basically.
Later in the year.
Yeah, until last year. We had already been crashing for a year and a half. Like you can't tell me, or you can't tell someone who lost, like even Tesla was down like what, 60% or something. You can't tell me that's not a crash. And then the people that were calling for a crash, even though we already had a crash, they want it to crash again. And so it's like a broken clock is right twice a day. Maybe they'll be right again. There's going to be another huge crash. But if you look at just like the NYSE 52-week low list, the market bottomed. The market of stocks actually bottomed in June. June is when the most amount of stocks made new lows. It just didn't happen in the indices until October, because that's when all the mega cap stuff rolled over, and Apple looked like it was going to fall off a cliff, and then it bounced. So it retested then. And ever since then, you've had a lot of really good breadth signals. Now, I'm not saying that we're going back to all-time highs or anything. So I do think it's going to be choppy, and that we've borrowed from future returns with all the printing that we've done. But I do think there's a lot of great companies that they're still like relatively affordable PE ratios. Like, I don't think you can look at the SPY anymore. Lord help you if you're looking at the Qs, because it's only like 4 or 5 companies. But if you look at like the RSP, so the equal weighted S&P 500, that thing bottomed at like 13 PE. So it actually got much lower versus like if you look at SPY, it was at like 15 or 16 when it bottomed in October, the low that everyone thinks. Where I'm like, well, we had more companies making lows in June. So we've kind of been grinding higher to sideways for the last like 6 or 7 months. So if we retest back down into those areas, I'm definitely going to be a buyer. I have cash like we talked about, and it all depends on your time frame. I'm not going to be buying ARK, that's for sure, or any of those types of things. Like other than Tesla, I'll buy that on pullbacks, hopefully back into that like gap around 145, 150 area. But I want to buy things that are doing well. I mean, like look at the home builders, like they actually did well. Heck, Progressive, I mean, the thing makes a new high every single day. Like, are we still anyone that says we're still in a bear market? I don't really see it, because you don't have the 52-week low list for the NYSE, which is like thousands of stocks. There's not all these companies making new 52-week lows. Like, that's a bear market. People are so stuck on the indices because of what's happened like the last few years, that they think that that's the only stocks that exist, and it doesn't. So while I do have indice positions, I do think that if you're stock picking, there's still a lot of great opportunities that are out there, and to buy some of these things on pullbacks. And then again, as they do go up, whether you're using covered calls or collars, like you sell a call and then buy a put to protect those gains, I think there's some great opportunity to do that. I'll be selling puts on things as they come down to try to buy at lower levels, either ride them up or then sell covered calls until I get called away. You can use iron condors, but I like to leg into iron condors if I can. So like as you go up into resistance, selling sorry, I hit my desk there, selling the bear call spread side. And then as we come back down into support, selling the bull put spread side. So you kind of leg into the iron condors. So I think that the best way to look at like trading, so not like long-term investing, but trading, is try and figure out what type of market we are in, and then use strategies that pay off in that type of market. If we're in a like trending type of market that we were in like 2017, 2019, everybody was a professional trader because we just went straight up along the 50 every single time. If we're in those type of markets, don't use iron condors, right? Because you're just going to get blown out on the high side. But we're not in that type of market. So we're not going to use strategies like momentum crosses, like moving average crosses. That's a horrible strategy right now because there's no momentum. You're just getting chopped up, death by 1,000 cuts. So figuring out what type of market are we in, and then using strategies that will pay off with that market. So as far as indicators, like it really depends. As far as a lot of breadth stuff, like I'll look at, as I mentioned, number of stocks making 52-week highs and lows, the percentage of the S&P that is above like a 50-day moving average or the 200-day moving average. And this might be a lagging indicator, but the last I looked at it, I don't think it was updated for today, but there was still like well over 50% of the S&P that was above its 200-day moving average. And last I checked, a lot of people use that as a risk on, okay, we're in a bull market if most stocks are above the 200-day moving average. That doesn't mean we're going to rip to all-time highs. That's not the definition of a bull market. And so I think sideways to higher, really grinding people up. I think there's a lot of people trying to be the next Michael Burry and call the next big giant crash. And history is just not on your side with that, because more people make money going long and holding things for the long term. And as bad as there are some things that are out there in the country, like I believe that the US and the US economy is the best place to invest. I don't want to be in any emerging markets. I want to be invested in the US. And history shows that over the long term, like that's been the better play. And so until something like that changes, and let's say like the dollar is no longer the world reserve currency, which we're nowhere near that right now. I want to be long US, and then buying pullbacks on things that I like, selling them when they go up, and then rebuying them. I don't care about a cost basis. Even in my IRA, like cost basis doesn't matter because you're not paying taxes on it. That's the only reason cost basis matters. I just look at the end dollar amount. If that dollar amount's going up, if I can sell something at 200, rebuy it at 180, sell it at 205, rebuy it at 190, like I'll do that all day long, especially in a retirement account.
Love that. Thank you so much. You actually wrapped up everything and what you're also doing in this sideways market so detailed. So I appreciate that. Like you said, and I agree, it's not just the indices. It's, in my opinion, I've been saying this for quite some time. It's a select stock market. And there's definitely some great stocks out there, great companies out there. And now we know that stocks don't always trade like their companies, but there are quite a few that have been trading pretty well. And I'll mention one, SMCI. And I mentioned that for quite some time. I actually got in, I think it was last spring, summer, the 30s and 40s, or something like that. And now it went back over 100. There was some short attack, I call it, or short report on there. And the company didn't respond. That happens a lot. You know, people sometimes want to get cheaper shares or something. Some of them are valid, but it's a solid company. I like the CEOs with Lisa Su in some video, adds a lot of credibility. Great numbers. Their PE, I think, was in single digits or something. But most importantly, what I look for in fundamentals and earnings, like I said before, free cash flow yield, earnings per share increasing. When you see triple digit percentages year over year, very impressive. Enphase also had great numbers consistently. But it's important to have increasing margins. And, you know, if we see that in a company in this tightening liquidity time period, you know, I take notice. So like you said, select stocks, company selection, and there've been quite a few. I'm definitely long, you know, a good amount. I also am very bullish on cybersecurity. That's been a sector that I've been talking about for, I think, years. I think it's a staple. I think it's a core necessity. And in my opinion, essentials and necessities are where I'm focusing on, looking for solid companies in those spaces. And cybersecurity, Palo Alto had beautiful earnings, a pattern now. Last one, they had excellent free cash flow yields. They came down a little bit this time, but excellent company. To me, they're the leader. I also like Fortinet. And, you know, the whole sector has Zscaler, some great innovative companies that are turning profit, which is very important to me during this time period. Biotech, medical, you know, there's some industrials, like you said, dividends, right? Deere is very, very innovative. They have used autonomous equipment and which increases productivity. You know, we have another issue of declining productivity during these times. So, you know, it's important. And new industries are birthed from challenges. So autonomous equipment is one of them. Deere, Caterpillar, those are great industrials for, you know, they have dividends, great for long term, in my opinion. But overall, I'm utilizing a reduced position sizing. And like you said, maintaining cash. You know, there's no reason to rush into anything, exercising patience. So that leads me to the risk management part of this, which is central to everything we do because it's key to protect our principal. We're not here to lose money. We're here to get a good return on our hard work money. So please tell us your risk management mindset.
Yeah. So for anything that's not a long-term investment, that like I would stick in my IRA, and I do trade my IRA probably more than I probably would like to, or trade things that are in there more than I would like to. I use an R system. So like a risk unit. So if I want to risk $1,000 on a trade and I want to risk $1 per share, then I know I need to buy 1,000 shares, that kind of thing. So, that's how I size my positions for like day trades. Like I traded FCX today. It was a day trade that I took, and I was going to risk $500 on it. It was about a 50-cent risk, so I bought 1,000 shares. Like that's how I size my day trades, swing trades. Position style trades are a little more based on like dollar amount. So I'm going to say, hey, a position is 20 grand or 25 grand. And like, that's how much my position size is. Of course, I like to play with options. So usually if I can do at least 100 shares, that's also cool. Like that's why I'm not in Chipotle, unfortunately. I don't want $140,000 worth of Chipotle. But if I can do 100 plus share increments and those position trades, I'm willing to hold longer. Then I can do things like callers, sell calls. I will buy protective puts if things break certain levels, and I'm willing to hold them, through that drawdown. But that drawdown is usually more technical. Like, hey, at this technical level, obviously it's breaking. I want out of this thing, and I'll take a loss. I have no problem with that. One of the best losses I actually ever took was I had sold puts on Alibaba at like 190, and things were going on with the stock that I didn't like, and geopolitically, etc. I was down like $300 on each of the puts that I sold, and I'm like, put selling, I usually like 95% of the time I'm making money on them. But when I don't, like, I'll take the loss and just get out. Thank God that I followed my plan and took the loss on those because I didn't like what was going on with the stock, even though I know they're high probability trades, because Baba just got slaughtered for like 2 years straight. And so sometimes taking a loss is the best thing that you can do, because yes, you lose the money, but if you're bag holding for a long period of time, you're losing opportunity. Like, you can put that money to work in something else. And then it's also mental. Like, there's a lot of traders that I've worked with and done some coaching with. I'm like, just sell these positions out of your account, and you will feel like a weight is just lifted off your shoulders, because they're looking at it every single day that they're trying to trade. And then they're staring at this other position that's just red, red, red. It's like, just take the loss. Like, this whole, oh, you don't lose until you sell, like, that's crap. Once the thing's down in your account, it doesn't matter if you sell or not, like, the money's gone. So sometimes it's better to just take the loss, move on to the next opportunity, because you could miss like a really good move. I could be worried about something that I'm down like 5% on, or I could find somewhere else that I can make like 10%. And then I don't have the mental stress of it, mental and emotional, and I can put the money to work elsewhere. So I really do think that that's important. And then oversizing positions, even in long-term accounts, like let's say Apple. Apple is one that I will allow myself to go over a 5% position. Now, I haven't done that in a very long time, because I just not really sure like how much further is Apple really going to go. Not that it's going to go down a ton, but it's probably not going to be a huge winner anytime soon, because it's so big, just law of large numbers. And so as something goes up, like, I will trim it over time, even if it's like selling 10 shares at a time. And then I can always rebuy them later. Or that way I just control like how large of a position size that is, because over time, a lot of long-term investors, like, they don't mean to have so much money in certain things. One of the things was like mega cap stocks. Like, at the beginning of 2022, I had a rather large position in SPY, and I just sold 20% of it, and I put it into RSP. So I'm like, my mega cap exposure is now massive, because I own some of these things individually, and I have SPY, which is outsized, towards the mega caps. So I need to diversify this a little bit. And so just trimming that position off and reallocating it is really important. I probably do that a little more often, since I'm pretty active as well. But if someone is just managing their own like IRA, in probably quarterly or every 6 months, it's good to look at, say like, okay, is this too much of my portfolio now? And now I need to trim and sell like 5% or 10% of the position. There's totally nothing wrong with that. I'm never married to any individual company, like, at all. Like, I'll sell it and I can just rebuy it. Like, I learned to detach myself emotionally from like owning shares of a company, because during 2020, I remember there was a couple companies, Square was one, and a Roku, that I bought like really, really low. And then during that 2020 explosion, they were up so much. I'm like, well, if I sell them, if I ever rebuy them, like, I'll have such a higher cost basis. And it's like, who cares? Like, I'm already up so much money, and thank God I sold Roku and Square. I rebought back and will Block, rebought back into Block. Not as low as like I had originally got it, because it was at like $30 and I had held for a long period of time. But it's like, does it really matter? Like, no, it doesn't. Even if I like the company, I don't have to own shares. One of the things I see this with a lot is Tesla. Like investors with Tesla, it's like they have to own the stock at all times, otherwise they feel like they're like not a true believer or something. It's like a religion, which is kind of crazy to me. And there's no reason to like just hold something through a 60% drawdown. Like just get out and you can get back in. I don't see any reason why you would want to do that.
Those are excellent points. Use the word marry a position. Excellent. It's about getting so attached to a stock, it's falling in love with them. I always say, love them and leave them. It's important that we don't get so emotional with our holdings. And, emotions are good. People always say, you got to eliminate emotions in your trading. That's untrue. We're humans. Emotions are actually very good, and they tell us a lot about ourselves. So what we do need to reduce is the impulsiveness and the reactions from these emotions. And also one of them is getting too attached. You can always buy it back later. Very smart of you to sell. Why hold during the drawdown? And of course, it's you make your money when you buy. So that's like that concept again. So if I had, let's say, Apple from 15 years ago, that's a different situation. But if you have a stock that you just purchased recently at a much higher cost basis, then yeah, you employ those stop losses and you have trailing stops. And, you want to make sure you can get out with even a small profit or even a break even. We want to try to minimize or eliminate that loss. And that's key. So great points with that. Thank you for sharing that. Progressive exposure. There's so many different strategies you can utilize when you go into positions, and when it's time to strike, and then when it's not, when it's time to just close it up and call it a day or call it a week. This market's been very tough. It's been rocky for quite some time. So great points that you make on how to generate alpha during this tough time period. I love your quote from your website, and you have a great website, Falconium Trading.
Thanks.
And you said, trading success comes from focusing on probabilities, not possibilities. And you referenced this before. And what I'd like you to do is please tell us the meaning behind that and what it means to you.
Yeah. So what it means to me is like, I want to focus on things that are consistent and repeatable and more likely to happen versus not. And that's where I feel like a lot of people that get into investing or trading specifically, because I day trade too. I don't think there's anything wrong with day trading. But a lot of people that get into day trading have wrong expectations, and they think like, oh, I could use this data expiration SPX call and I can make 1,000%. Like, yeah, you can. And if you do that with your whole account, you could make a lot of money. But the likelihood of that happening is not very high. And so I don't want to be buying lottery tickets all the time. Like, yes, sometimes it's fun. I've done it before. But most of the time, like I want to be playing with the odds, like with the house. That's why I like strategies like selling option premium, because a lot of the times I know like, hey, this is a high likelihood that I'm going to make money. It might be a reduced amount versus, buying an option that's going to go up 100% or something like that. But I know that it's most likely going to go in my favor, because trading is it's an ultra marathon. It is definitely not a sprint or a race. The market will always be there tomorrow, except on the weekends. And there will always be another opportunity to catch a different stock. A lot of times these moves on charts and technicals, they all look not all of them. They oftentimes look the same. And if you miss one opportunity, like put yourself in a position to catch the other one, versus focusing on, oh, I want to buy this and this, like Tesla. Oh, Neo is the next Tesla. I saw more people lose so much money on the possibility that it's like the next big thing. And usually none of those are correct. Like, especially with all the China stuff, like Luckin Coffee is the next Starbucks. And I saw some people that sold a bunch of puts on that thing. And then it was like, oh, they actually were cooking the books, or Baba is the next Amazon, or, Baidu is the next Google. Now it's like the next chat GPT. Like, yes, there's a possibility that that's going to happen. Is it probable? No, it's not probable. So I don't want to lose my money trying to chase things that are, 1 or 2% likely to happen. I'd rather just stick with something that's like, hey, 85% of the time, like this trade's going to make money. 90% of the time, this trade's going to make money. It might only make 1 or 2%, but you know what? You start adding up all that 1 or 2%, and it becomes a really good return. And people don't realize that if you can really earn, if you look at the rule of 72, like to double your money, divide into 72. So if you can make 12% a year, divide that into 72, you double your account in 6 years. Like, if you could truly do that. And some people think, oh, 12%, like that's nothing. It's, if someone could do that for a long period of time, like they'd be one of the best traders.
Yeah, I mean, that's consistently. And yeah, when you see you make 20, 30, 50% of a trade, yeah, but then think of the other trades that you lose or you don't make that. To get a consistent 12% is significant. And
some of the best money managers like on the planet have had like compounded annual growth rates of 15 to 20% over like long periods of time, or maybe 25. But some of these people, it's like, oh, I make 50% every year. It's like, you might have made it 1 year. You're not going to make that year over year over year. Otherwise, you should start a hedge fund and you'll have people throwing billions of dollars at you. So it's like, I want to focus on what's probable and what is more likely to happen and like make me money, because that's ultimately what we want to do when we're investing and trading. I want to put money to work and my time, and I want it to come back to me with more of its friends. Not like throw it out there and hope that like, oh, hopefully this is the next, XYZ, and I'm going to hit some big, huge, return. And there was a lot of that the last couple of years. Like some of these IPOs and SPACs, I mean, it was just crazy.
Oh, yeah, the SPACs. Oh gosh. I mean, everyone was thinking it was going to be, they're always looking for that next Amazon. And we've had this discussion before on other podcasts, and everyone's like, everyone's like so crowded to find that next Amazon. And, those are very far and few between. And, that consistent small wins, like we've been talking about, is really where it's at. And it's the longevity in the market. Like you said, it's an ultra marathon. It's about staying in the market and being consistent. And I love that you bring such reality, Robert. And that's so important, your transparency in all this, because that's really what's important. It's about being realistic and, about our portfolios and our returns. And you mentioned your quote about probabilities. And yeah, I mean, I look at, expected value. You always look at the probability of an occurrence of how much you're going to make, plus the probability of how much you're going to, you come up with the expected value of an investment. I look at CAPM, you look at Sharpe ratio for, I always look at cost benefit analysis, all these risk adjusted returns. And it all comes back to, like we've been discussing, risk. And we need to manage our risk, and we need to be realistic about it, and it's very important. I wanted to mention one more thing. You were talking about options before we wrap up, and I want to talk about your business and what you offer for all the people. Do you do diagonals? I'm really a fan of diagonals. For example, I always buy a long call. I always try to go 3 months plus out. Sweet spot's usually 3 to 6 months. Sometimes do 9 months. But in this market, I've been shorter because it's so much uncertainty with long term, not willing to pay that high premium. I'll buy a further out call, and then I'll sell out of the money higher, strike shorter term. Do you utilize that strategy as well?
Yeah, it's often called like the poor man's or poor person's covered call. So you buy like a deep in the money leap, let's say, and then you sell shorter term duration against it. I do utilize that from time to time. Right now, because we are like so choppy and sideways, and again, I don't think we're just going to take off. I would prefer to own the shares and then sell the calls against it, just because even with leaps, you still have theta decay. So I haven't been using that strategy a ton lately. One in a sideways market that is pretty cool though is I call it a cash calendar. But you buy a longer dated put and then you're selling front week or front month puts against it. Because that front month generally has more premium to it, more volatility. And in a sideways market, that thing's really going to get eaten up. And if I can pay for like a longer put with, let's say, like 3 or 4 weeks worth of short puts, then like that long put becomes free. And then I can just keep doing that with the short puts until that long put gets within like 45 days or so to expiration. You really have to manage your delta. Like, you want to make sure that you're still delta positive, because if something does go up, if it goes up too fast, then you're going to start losing money because you have that long put, and your delta will become negative. Same thing with like the diagonal with the leap and then selling calls against it. You can get what's called delta capped. Like if it goes too far, too fast, where you're not making money anymore. So you have to pay a little more attention to things like the delta, and then you got to look at your theta decay, et cetera. So it's a little more complex. So I do that a little bit, but I haven't been doing it a ton lately.
Yeah, I haven't been buying leaps in this market at all. I'm actually not a fan of leaps overall, for many reasons. I'm not going to get into all of them, but yeah, I'm not really a fan of them. I agree with you. I'd rather buy shares. And if I'm going to go that far out, I'm going to just get into shares. But I've been buying 3 to 6 months out, long calls, and just selling like 2 months out of the money, higher strikes, and they've worked out pretty well. And then, when you say about legging into options, that's the beauty of options, is the flexibility and how you can leg into different parts of the option, and then you can roll out and you can roll up. And I've rolled quite a few short puts myself. And, in the covered calls, I've been rolling them. And in this market, I have to say, I'm sure you'll agree, it's been a beauty to sell covered calls because it's been so choppy and it's been sideways. I've had covered calls expire worthless. I've had to roll a few times, but they've expired worthless, which I love. And I also leg into covered calls. Let's say I buy a position, they have this thing that you buy the position and you sell the covered calls at the same time. I'm not a fan of that. I don't do that. I buy my shares, and then once it appreciates past a certain point where I feel comfortable possibly selling them, then I'll sell covered calls. I mean, of course, it all depends, right? That's what I would do as well. So flexibility. Keep in mind.
With the legging in too, like if I have a position that I have, multiples of 100 shares. So let's say I have like 300, 400 shares or something. I'll usually sell like 1 or 2 calls. And then if it goes higher, like then I'll sell more. Like there's no reason for me to really sell all of them at once. That way I don't like completely cap my gains. And if I get called away, like I'm fine with it. I'll just like sell it or wait for it to come back down, especially in this market. Cause I don't think that things are going to just run away from us back to,
And so it's about not having that emotion of fear of missing out as well. So just knowing that, like you said, I love your attitude that you're just like, you know what, it runs away, so be it. I don't have to hold
I'll find something else.
Right? There's always so many opportunities. There's plenty of stocks out there. And there's always, like I think Warren Buffett said, there's always another bus that comes. So there's no reason to hold on to something as it's going down because you feel like I have to be a block shareholder. And that's part of who I am. I identify with being one, and it's like, so yeah, those are all very important. Keep an open mind, stay positive, and know there are many opportunities coming. Absolutely. So Robert, I've enjoyed speaking with you so much. Please tell us about Falconium Trading and what you offer for everyone, because we definitely want to know.
Yeah, so I started Falconium Trading when I left the prior trading education company. It's a little more focused on like existing traders, like a community to trade with in Discord. I post trades that I take. Sometimes like I'm not able to post the actual chart. Like this morning, like FCX was moving really fast. There's a 3-minute hammer candle that came in about 9 minutes after market open. And so I basically bracketed that candle. So that's like an alert that I would put in there. Just, hey, 3-minute hammer on FCX. And this is on my watch list.
Mhm.
That's what I'm taking. And then, hey, my target is
Oh, please
43.
tell the people in case they don't know what that means. Just walk them through your thinking when you saw that and what type of trade you put on when you saw that.
Okay. So FCX was a gap up. So the price opened higher than it closed. And I think all the steel stocks did today. So I was watching that, X, Nucor, and this FCX threw in a lower wick, like through the low of day. So price took out the low of day. When I day trade, I try to look for people that are trapped. So
Mhm.
because there's always buyers and sellers, and then I want to exploit whoever is losing money. So when it breaks that low of day, people love the short stuff like that. So it breaks the low of day. People probably get in short. Someone gets in short. And then it closed back above not only the low of day where it broke, but it also closed above the prior candle. So that represents bullish price action because that long tail on the candle is where the price went all the way down and then came all the way back up. So anyone who shorted that low of day break was trapped. So I just entered above the 3-minute hammer candle with my stop below that. So I'm getting in on a bullish breakout because if they did enter short, they probably have their stop somewhere near like high of day or that particular pivot point. And in order to get out of a short position, they have to buy to cover. If they're buying to cover, that's more buying pressure, and I'm already in. And then I was just targeting a pop to the round number of 43. You know, FCX isn't a super large company. And so a lot of times those big round numbers, I call them grandma numbers. Hopefully that doesn't make anyone feel bad. But it's kind of like, you know, the grandma or grandpa that's like, oh, sell at 43. It's a big round number. So like I use that as a target a lot of times. And so that way I have good risk reward. I was risking, I think I initially sized it for 50 cents and I just tightened it up to the low so that I could calculate the number of shares really quick in my head because I was looking at something else and I just looked over and I'm like, oh shoot, I got to take this. So I sized it for 50 cents. And then as soon as I was in, I tightened my stop up about like 30 or 32. And then, you know, good risk reward based on that 30, 32 cents. I think I got 40 cents or so. I got in at 40.61, 39 cents per share, risk 30. So, and then I just set my target at 43. So I alerted the team like, hey, this is what I'm taking. They can take that if they want. Obviously, they don't have to. Or another trader in there was like, hey, Alcoa, like metals for whatever reason today were up really nice. So Alcoa initially dipped, it consolidated. I'm looking at the chart here. Threw in an upper wick through the volume weighted average price. Looked like it was going to roll over and then broke back through. And so another trader said, hey, I'm taking Alcoa along above this upper wick, 7:30, 7:39 my time. I'm on Mountain. So 9:39, 9:40 Eastern. So like he threw in, hey, he's taking that. And then someone else, you know, ended up taking that same trade. So it's a community for people to trade together. I share a lot of what I'm doing, or like I sold a covered call on CRM, which has earnings after hours today. So like I have an options area where I said, hey, I own shares of Salesforce. I'm selling a regular March 180 call for $3.10. And I alerted on that. Or like when I mentioned the Tesla naked puts that I sold, I alerted on that. And then I'll say, hey, I'm buying them to close for, I think I bought them for like 60% premium capture. And then, I mean, Leah actually today, she said, hey, knee is coming in. NextEra Energy is coming into a big support. And I'm like, yes, thank you for the reminder. I had an alert on it, but the alert hadn't hit yet. And so I sold puts on NextEra Energy today. And I got that trade because Leah said, hey, knee looks like it's coming into a strong support. So it's a community for people to share trades. People can take them if they want. And then 2 times a week after market closes on Tuesday, Thursday, I do like a little swing trade room on Zoom. So people will request stocks. I'll take a look at them and say like, well, here's what I would do, or here's what I am doing. It's like yesterday I shorted Ulta. God help me. This thing's been so strong.
Oh, the
But
beauty stock, those
yeah,
I don't short the beauty ones, Lulu and all them.
yeah, it was
Your beauty
closing below the
cells.
20, and I'm like, okay, I'm gonna take some Ulta short, and my stop's above 530. If it takes me out there, fine. If
Yeah,
not, we'll
yeah.
see if it can roll down
And
a
you
little bit.
enter your stops. You don't do mental stops. You put them in actually when you
Yeah,
purchase the
yep.
stock, right?
Yeah, I use First Trigger's OCO for almost everything. Um, but yeah, hard stops that are in there.
Nice.
And I
Yeah.
like it because I don't have to do anything. Like I can go do something else. My stop can
Yeah.
get triggered or my target can hit because I don't want to like sit at the computer all day long. I mean, I love the
Oh,
market, but
listen. Yeah.
yeah, I don't want to sit there all
You
day.
love it, but I don't know if you love it that much. I mean, you don't want to
Yeah.
sit there all day. You
Yeah.
don't
So
want to
two,
babysit your stocks, right?
yep. So 2 times a week, I do that for about an hour in the afternoon. And then that's usually when I'll also take part of that time to do some type of education or teaching. Like when I was doing that structured deal, that structured trade that I put on, I was showing other people that they had never heard of like a zero coupon bond. So I'm like, well, this is what it is. And this is how I'm going to use it. And if you guys want to do it, great. If not, that's fine too. But this is what I'm doing. And so I'll share those types of setups in that like swing trade room. And then I post the recordings. They get uploaded to YouTube unlisted. And then I post them in a channel there in Discord. So it's like a monthly subscription. That's pretty cheap. It's $75 a month. I do one-on-one coaching for, sorry, that was TOS, the market closing there.
Oh,
The bell,
yeah.
if you guys heard it. But I do one-on-one coaching as well to walk people through like my process or technical analysis, because I think the perfect trades are when the technicals line up, the story lines up, and the fundamentals line up. And if you can get all three of those, you can get really, really solid moves. But sometimes fundamentals don't matter. Sometimes technicals don't matter. And sometimes all that matters is the story on some of these things. And
The sentiment.
yeah,
Yeah,
so
there's so
when you
much.
can get all three of those that line up, like that's the best. So I'll use those 2 afternoons as like teaching opportunities to share things that I've learned. I am always a student of the market. There are some really great follows on Twitter, and if I find stuff that's like really good, I'll share, hey, what I think is a really great information, and kind of help people like sift through what I think is also just junk. Like when people are just constantly taking like analog 2008 charts and overlaying them with the current price action like that, I think that's pretty useless. And so like those types of things like, hey, don't pay attention to this. I think this is important. Here's why. What you want to do with that information, that's on you. Again, it's not financial advice, but those are some of the things that we do. I am going to be recording some classes too, like covered calls, like my strategy that I use when I sell them. And then also showing people how to practice them is also really important. And I use Think Back on TOS to show people, okay, this is how you can tell when volatility is expanding and when you're going to get a good deal on selling a call. And then if it pulls back, like when you can rebuy it. And then if it pops again, you sell the same call again, oftentimes. So I'll be doing that, but none of those are up yet. Those are primarily what I do with Falconium Trading.
Oh, wonderful. That's great. Thank you so much for sharing. And thank you so much for taking the time today to tell us about your strategies, your thinking, your background, everything. I really appreciate this, Robert. Your website is falconiumtrading.com. Is that correct?
That's correct. Yeah. And it's been a pleasure. I've had a lot of fun. I think we've gone on like about 2 hours. So yeah, time flies when you're having fun.
Absolutely. I've enjoyed our topics, which are all of strong interest to me. I'm an options trader, real estate investor. I think I'm your senior here. I've been doing it for quite some time. I'm older than you. That's why I called you a baby. But you're very close in age. I don't remember the 70s and 80s myself, but we do read the history books. And like you mentioned, Volcker, and we know our history and, we learn from it. And just like you said, and then you made a great point about 2008, because we know our history, we're going to react differently this time around. And unlike in 2008, when no one wanted to touch the real estate, now they're like, oh, in hindsight, I should have picked up that cheap real estate, right? So maybe this time around, if anything did happen, people would see things differently. And so we learn from our history. Hopefully we learn from our mistakes so we don't continually repeat them. But I'm also a student of life. And I call myself a philomath because I'm a lover of learning. And the market has a way of teaching us every day. And that's probably why we love it so much. It's so exciting, is that we're always learning, we're always growing, we're adapting, we're changing, and we embrace it and we love it. So I wish you the best, Robert, and to all the listeners, thank you so much for listening. And until next time, take care and have a wonderful day.
Take care. Thank you.